Welcome to this Moneybox Personal Finance Q&A, our first one of 2025. My name is Brian Burns. I'm Head of Personal Finance at Moneybox. For anyone that doesn't know, Moneybox is a digital saving and investing app. Our mission is to help people build wealth with confidence across saving, investing, home buying, and retirement. I am delighted to be joined today by Mr. Rotimi Merriman-Johnson, aka Mr. Moneyjar. Rotimi, thank you for joining us. Would you care to introduce yourself to the few people I imagine that don't know you?
Yes, my name is Rotimi Merriman-Johnson. Thanks very much for having me on this episode. And I run a personal finance platform called Mr. Moneyjar, and I talk all things personal finance, investing, getting on the property ladder. I've been doing it for 4 and a bit years now.
Now, I knew you were going to be extremely modest when you were introducing yourself. So to embarrass you, I have written down a short list of other things that you are beyond Mr. Moneyjar.
Oh, God.
I would say a social media sensation, I think is fair to say.
Okay.
A qualified financial advisor as well. Host of the Mr. Moneyjar radio or show slash podcast. A regular on TV and radio across BBC, Sky News, BBC One Extra's Future Figure of 2024. Ambassador for the National Numeracy Charity. And I've also seen you across 2024 in Westminster, in Downing Street, I believe, as well, and in the Bank of England. So
the House of Commons.
And the House of Commons,
Lords.
exactly, yeah. So you are an extremely busy man. So thank you very much for giving up the time.
I'm glad you said that about me. Yeah.
Thank you. The format for today, so we're just basically, it's January, obviously, as we are recording this. So there's a lot of talk at the moment about New Year's resolutions, financial goals for 2025. So we're going to chat about that across saving, investing, home buying, and retirement. And we've also got a Moneybox customer Q&A. So we went out to our customers a couple of weeks ago and we asked them for submitted questions of things that are on their minds coming into 2025. And we've been inundated with questions. So we've picked the most popular ones. So you and I are going to have a chat about those, hopefully. Nothing that you hear today from our audience perspective is financial advice, though myself and Timmy have both done our qualifications in the past. If you do need financial advice, we do recommend speaking to an independent financial advisor who can help you with your individual circumstance. But before we get into the meat of it then, Rotimi, how do you genuinely feel about financial resolutions or New Year's resolutions as a whole? There's obviously pros and cons, but is it something that you subscribe to for you and the Moneyjar community?
Yeah, I'm a great fan of New Year's resolutions. I think that when it comes to setting resolutions and goals, what's important is to have a few big ones rather than lots of little ones. I think as a general rule of thumb, if you can't tell people what your goals are off the top of your head, then you probably have too many. So I think 3 or 4 is great. And if you can set the goals for a date in the future, measure them, track them, I think the start of the year is a great time of the year to do that.
Nice. I'm going to put you on the spot and say, have you made any resolutions 2025, financial or otherwise, that you would be willing to share with the audience? No problem if not.
Yeah, that's a great ask. I'd like to do another big race this year. So I wanna run a marathon every year until my legs fall off. So
that is a very good resolution. Did you run one last year?
I ran one last year, not the year before at Berlin. Yeah.
We conducted some research recently, and it showed that 53% of people are optimistic that 2025 will be the year that they get their personal finances, back on track. I think it's fair to say that the last 3 or 4 years have been challenging for people's personal finances.
Yes.
So would have been almost impossible to miss the cost of living crisis. Obviously, inflation has been a real challenge, and subsequently interest rates have been quite high, which has been tricky for people trying to get onto the property ladder. But as I say, the recent research that we did said over half of people are optimistic about the year to come. And
53%.
53%. And we'll return to that theme of optimism a little bit later on. But our first main topic for the day is going to be savings. So again, a very common financial resolution is some variation of being better with money, building up a savings pot, an emergency fund pot, which typically is kind of 3 to 6 months worth of expenditure. But How do you think about setting savings goals, or if your community are talking to you about, I want to be better with money and get an emergency fund together? What are the typical things that you'll talk to them about?
Yeah, so you've kind of covered off the first aspect of saving, which is to work out what you're saving for. So an emergency fund could be a reason. You could be saving for a house deposit. You could be saving for a holiday, for a wedding. So know in your mind what you're saving for. Work out how much you will be saving. Put that at a specific date in the future and divide that amount of money by the number of months between now and that future date. And then you just automate it. Like, one of the most useful things that you can set up when you're saving is a standing order. And you just set that up to come out on or after payday. And you know that once that number of months has elapsed, you'll hit your savings goal. And you can track and celebrate small wins in the interim.
And at Moneybox, we actually have something called a payday boost. So you can set it up and you can put it into the app of, okay, my payday is the 25th of the month. And you can say, on that day, I want to put in an extra £100 into my savings, and it will do that automatically, because there's two things really at play there. One is the automation, so you don't have to think about it. And the second one is crucially paying yourself first.
Yes.
So quite often when we think about money or savings, it's okay, if I have something left at the end of the month, I'll put it into my savings or investing pot. But actually, I think we know that you're probably more likely to be successful if you pay yourself first when your money comes in from your payday. Is that something you'd subscribe to?
Yeah, absolutely. I developed the pay. So when I first heard about paying yourself first, I didn't really understand what it meant. But as you just said, it's about, making a payment to your future self before you then pay your bills and all of the other expenses that you have throughout the month. And I got into paying myself first accidentally. How many years ago now? Probably 10 years ago now, with the Help to Buy ISA. So that was automatically taking out £200 from my account every month. And what I found was I didn't notice it after a few months. You just adjust to that amount of money. That is due to something called Parkinson's law. So it's normally attributed to time. And it says that the length of time it takes to do a task will swell up to fill the amount of time that's allocated to it. Well, the same is the case with money. So if you can save first, then your brain will naturally adjust to the amount of money that you have left to spend for the month.
I think one thing in our recent research that surprised me ever so slightly was, in 2024, people managed to commit 17% of their income towards their savings goals, which was up from 14% the previous year in 2023. So that could be saving, investing, it could be putting money into a lifetime ISA to save for their first home, or it could be their pension savings, for example. That was up 3% on the year above. So despite cost of living pressures, inflation, interest rates, people still are able to dedicate a portion of their income, a decent portion of their income, towards their future you. Do you feel it's challenging sometimes to get that balance right when you're speaking to the Mr. Money Jar community between, okay, times are absolutely tough, things are still expensive, inflation, things have gotten a lot more expensive and they're not going to get kind of any cheaper, but you're still able to hit your financial goals? There's sometimes a challenge in talking about those two things, which can both be true at the same time.
Yeah, I've seen two things from the community and actually from the nation in general over the past few years when things have been quite tough. One is that because things can be quite pessimistic when you're reading the news and things, what I found is that people are actually far more open to seeing the small actions they can take today that will benefit them in the future, because it gives you that sense of control back. Secondly, where I've seen prices increasing, people have become a lot more selective with how they spend their money. And so whereas they would have splurged on a bunch of things that they maybe didn't care about or want before, people are now spending on the things that they actually care about and then just not spending on the rest. And I think it's great that people are still saving.
Okay, if we go on to then our customer submitted questions
Yeah.
about saving, it won't surprise you. This is a theme across saving, investing, home buying, retirement. But there's a lot of people looking for predictions for 2025, and the most submitted question about savings was, what do we think interest rates will do in 2025? This is obviously a familiar question that kind of anybody gets if they ever talk about personal finance or savings, but do you want to have a stab at your response to that question when you're asked for predictions about things like interest rates?
Yeah, when it comes to interest rates, the first thing I say is that no one has a crystal ball, so no one knows what's going to happen. We do know that there are 8 interest rate potential changes throughout the year. That's the number of times that the MPC, that the Bank of England, meets. Having followed the autumn statement extensively last year and seeing the rise that's coming into employers' national insurance in April, I think it's quite widely accepted that the effect of that is going to be inflationary. And so I would expect interest rates to either stay the same or to increase in the medium term. And we saw that in Q4, where interest rates were actually lowered from 5% to 4.75% in November. And in the last MPC meeting, they were held at 4.75%. So we'll see what happens this year.
So I think one thing that both of us would be relatively comfortable predicting is there's probably no return to interest rates being sub 2, sub 1% as they were for a decade from kind of 2010 to
Yeah.
2020.
I mean,
This
no.
3, 4, 5% range for the foreseeable future is probably more realistic.
Yeah, never say never, but I think that those were quite unique times that we were in at the moment, which is when we had to close off parts of the economy because of the pandemic, and so interest rates were lowered to stimulate the economy. Now we're trying to do the reverse and control prices, control inflation by raising interest rates.
And we'll come on to home buying obviously in a little bit, but from a savings perspective, higher interest rates are good. Like we're seeing easily kind of you can get 4 or 5% on your savings with a little bit of shopping around, which again, we didn't see that for a very long time, for 10, 12 years post global financial crisis. So from a pure savings perspective, higher interest rates are a good thing.
Yep.
The second most popular question that we got in was actually balancing off savings, building up an emergency fund, saving for a future goal versus paying off debt. So paying off things like credit cards or loans. How do we get the balance of those right? Some people would say, look, you should pay off all high interest debt, all debt that you possibly can do before you start saving towards other goals. Other people would say you can actually balance off the two. You can be doing both at the same time. Do you have an opinion or a kind of recommendation of how people should be thinking about saving versus paying off debt?
Yeah, if you have high interest debt, the most important thing to do is to just stop using it. So to stop using either the credit card or the overdraft. Overdraft in particular are quite pernicious. Their average APRs are double that of credit cards. So to stop using it and then to have a plan to pay it off. And whether that's the snowball method or the avalanche method, for the people who don't know what those are, with the snowball, take all of your debts, pay off as much as you can off the smallest balance, and you pay the minimums on the rest, and you rinse and repeat on the next smallest balance until all the debts are paid off. And with the avalanche method, you take the most expensive debt first, and then you pay off as much as you can from that and do the minimums on the rest. I think it's more about having that plan. The thing is, if you don't save an emergency fund and an emergency comes, you're going to have to go back to use the credit card or the overdraft anyway. So I would say save a small emergency fund. I don't want to give a number because everyone's circumstances are different. Whether that's 250, 500, a grand, save that and then come up with that plan to pay off your debts as well.
Nice. And then the third most popular question that we have from a savings perspective, and this is an interesting one given where interest rates are now, and as we say, you get a decent interest rate on your savings, is do people generally get taxed on the savings interest that they earn? Generally speaking, not a problem for that decade between 2010 and 2020 when we weren't earning any interest on our savings. But now that we are, do people generally get taxed on that savings interest?
So it depends on what you're saving into. If you save into a cash ISA, then there's no tax to pay for as long as it stays within that ISA wrapper. But if you're saving into a savings account, so that could be easy access account, it could be regular savings, it could be a fixed term account, then you will be you have to work within what's called the personal savings allowance, and the amount that you can earn depends on your tax bracket. So basic rate taxpayers can earn £1,000 of interest tax free, higher rate taxpayers can earn £500 interest tax free, and then additional rate taxpayers don't get any personal allowance at all. So if we're looking at current interest rates, you'll need about £20,000 in savings as a basic rate taxpayer earning 5% to exceed that £1,000.
And I think between the personal savings allowance and the ISA allowances, I think it's fair to say that the vast majority of people shouldn't really be paying tax on their savings interest. You can put £20,000 a year into an ISA, into a cash ISA, any interest that you earn on that, completely tax free.
Mm-hmm.
And the personal savings allowance, as you mentioned there, is relatively speaking quite generous to mop up anything that might be outside of your ISAs. So most people, if you structure things kind of correctly and you use your ISAs correctly, shouldn't be paying tax on savings interest.
Absolutely, yeah.
And then the last one, and this is more of kind of resolution based kind of 2025. How do we make savings habits that last beyond January, hopefully last for the full 12 months ahead and into 2026, 2027 and beyond? How do we make savings habits that actually last? I think we touched on a couple in terms of automating your savings and your finances, but anything else you wanted to touch on there?
I think accountability is great. If you can, so on top of the picking an amount that you're trying to save for, automating it, save into a separate savings account. So the account that you get paid into, try not to save into that as well, because you're most likely to dip in. So save into a separate savings account, and then having some accountability can help you with saving too. So if you can save with a friend or a partner, then you're both accountable to each other. You can track your progress together, and that's something that helps as well.
Yeah, I'm a huge fan of that. I can't remember the exact kind of percentage, but even just saying a goal out loud or writing it down increases your chances of hitting it much more than if you just kind of keep it in your own mind. And I think it increases again if you say it to another kind of actual person. I will do that myself. I will say what my goals are for the year to my wife, just so that in 2 or 3 months she can say,
Yeah.
oh, how are you getting on with
Yeah.
that thing? Like, I know it's a bit more accountability for myself just by saying these things. Next topic, investing. It's a big one. We could probably spend most of our time on this one. I'll start by saying I firmly believe that not enough people in the UK are investing. More people can and should be investing, and it's a mission of Moneybox and my personal mission to get more people investing when it's appropriate for them to do so. Let's cover off a couple of those bits in terms of when it's appropriate to do so. So the things that we've just talked about are highly relevant. So paying off your high interest debt is a very sensible thing to do before you start investing, and also building up that emergency fund as well, because investing is for the long term and you don't want to have to dip into your investments at a inopportune time if an emergency comes along. That's exactly what your emergency fund is there for. We did find in our research that investing more is the second most common goal from the people that we spoke to in 2025. And also some previous research that we did said when we asked people about their financial regrets, 25% of people regretted not investing. So big question, but what can we do to get more people investing in 2025? And what are people in the Mr. Money Jar community kind of talking to you about when they talk about investing?
I think investing is one of those things that people want to do and feel like they should do, but they don't feel comfortable with. It's almost like, what platform do I use? How does the sign up process work? Will I lose money? So I think the first step with investing is just education, like listening to podcasts, picking up books, speaking to people in your circle and seeing how they found their investing journey. I think a lot of it's to do with unfamiliarity. Because when I speak to people, I'm like, look, setting up a stocks and shares ISA with an investing platform, it's like opening a bank account online. If you've opened a bank account online, you can do that. So start with the education. I think it's great that with Moneybox, for example, you can start a stocks and shares ISA with £1. So the minimums are super low. And when I first started investing, I treated the amount that I was investing into my stocks and shares ISA almost as like the cost of my education. So I took an amount that I could afford to lose, £50 and invested it. And I said, for the next 6 to 12 months, I'm going to see what happens with this money. So it's educate yourself, start small, and then build as you continue going.
Let's move on to the customer questions. I think I'm going to give us both a stab at answering the first one, because it is absolutely, I think, the most important one. That's just how to get started
Sure.
investing. I think you hit the nail on the head by the very first thing you said, in terms of people want to be investing. Generally, they know that it's a good thing to be doing. It can just be quite difficult to take the first step because there can be some fear around it. You don't want to make the wrong investment. You're worried about losing money, whatever it might be. Again, when I talk to Moneybox customers, I try and break it down to three. There's really only 3 steps or 3 decisions that you need to make. You need to choose the right account to start investing. And we've mentioned a stocks and shares ISA a couple of times. That is something where you can put aside up to £20,000 per tax year, and any growth that then comes within that stocks and shares ISA is tax free. So for most people, investing up to £20,000, a stocks and shares ISA is going to be a very good place to look. So that's the first decision, and it's, in my mind, relatively simple. The second one then is choosing the investment, which can be a little bit more difficult, but providers such as Moneybox and others now offer ready-made starting options to make it very easy for you to get started with a low-cost, diversified investment portfolio, where you're not investing in one company, you're investing in lots of different companies, and therefore you benefit from diversification, which most people are probably aware of and realize is a good thing. So that's the second step. And then the third step is choosing how much to invest. And I think you quite rightly, again, hit the nail on the head of starting with something. It can be a different amount for everyone, but starting with a relatively small amount, say £50 or whatever it might be. You might even want to do that as just a once-off, put in £50 or £100 and monitor that for a couple of weeks, couple of months, until you're used to seeing the fluctuations of your money being invested rather than saved. And then setting up some sort of automated direct debit to do it on a monthly basis, kind of going in just to get into that habit of investing. So whenever I talk to people about getting started, those are the kind of 3 steps to try and break it down to something that's simple, easy, and not something that you need to be scared of.
Yep.
Is there anything that you would add to that in terms of people wanting to get started investing?
Yeah, I think everything you said is spot on. I did also have another thought about why people are put off investing, and I think it's this thing around risk. And I know we've spoken about this before, where when it comes to investing, you often get the disclaimers saying investments can rise as well as fall in value. You could lose all of your money. And I think that that's true. There's no such thing as a 100% risk-free investment. But if we look at the data, and we have several decades worth of data at this point, the longer that you invest for, actually the less risky your investments become.
Educating yourself about investing, about these terms like stocks and shares ISA, diversification, that sort of thing. There is an incredibly supportive community out there built by people such as yourself to help people really understand investing and kind of de-risk and take away the fear of it as well. I think there's also a bit of an acceptance, certainly in the last kind of, I'd say, 12 to 18 months, that maybe when we talk about investing and the language that we use around it, we've probably over the last decade tilted a little bit too far towards the risk side of things. And exactly what you mentioned there in terms of the value of investments can go up and down, which they absolutely can in the short term. But we also need to talk more about the long-term benefits of investing, exactly as you said, and how investing in a diversified portfolio over the long term is quite a sensible and, relatively speaking, lower risk thing to do. Obviously, investing over the short term can be quite volatile, but yeah, we just need to get that balance between the risks and the benefits of investing probably a little bit better as an industry going forwards.
Yeah. So 2 more things I want to pick up on, Brian. So yeah, this thing about diversification. When I first started investing, I bought a stock. And I think the reason why, and I see this a lot from people who start investing, they buy individual stocks. And I think a big part of the reason for this is because you're coming at it from a consumer angle, and you're like, I have an iPhone, so I'm going to buy Apple stock. And you can do that. But the thing is, if you invest in just one company and that company has a bad quarter or falls upon hard times, you could see quite a big swing in the value of your investment. So as you said, You can buy funds, you can buy baskets of companies which track particular countries, sectors, or even the world, just a global stock market. And that's not to say that those don't rise and fall in value as well. They do. But a global fund could contain thousands of companies in it. So for you to lose all of your money, everything in that fund would need to go to zero. And this is part of the reason why tracker funds, or index funds as they're also known, are so popular. That's the first thing. The second thing I'll also say is, for people who don't actually have a stocks and shares ISA with an investment provider, you buy the investments. So you actually put your money into the stocks and shares ISA and then use that money to buy investments. Those investments can rise and fall in value, but that doesn't mean you've gained or lost any money. That is just the value of your investment, which will be shown to you in your app or on the website. Only when you sell do you realize the gain or the loss. So what that means is, if you invest a certain amount of money and the market falls 25%, and you don't need to sell your money at that particular point in time, you haven't lost anything. It's just gone down in value. It's like buying a house or something. If the price of your house goes down, you don't have to sell your house, then you haven't lost any money. If the market then recovers and your investments are, say, plus 10% or plus 25%, and then you sell, then you've actually made money. And the same is the case with the house analogy as well. This is why we invest for the long term, because in the short term, the market does that, but in the long term, it trends upwards, and it has done for many, many decades.
Okay, so the next most popular question that we got in from our customers, what's the most common mistakes that we see when it comes to investing?
Trying to time the market. So thinking that you have some special advantage in that you can buy bottom and sell at the top. You can very easily circumvent this by pound cost averaging, which is where you take an amount and you invest it into the market every month. And that takes a lot of the emotion out of investing, a lot of the timing as well.
Excellent. Okay, next section, trying to get onto the property ladder, home buying. This is always a popular topic. Whenever we go out to our Moneybox customers and we ask them, why are you with us? What are you saving for? Trying to get onto the property ladder is always an extremely popular answer. I think it's important to acknowledge the environment that we find ourselves in when it comes to trying to get onto the property ladder. We don't need to tell anybody what house prices have done over the last 10, 20, kind of 30 years. Interest rates are higher than they were over the decade 2010 to 2020. And the amount that people need to save up for a deposit compared to what people are earning these days is obviously quite a lot different to what it was over previous kind of decades. Whenever I talk about trying to get onto the property ladder and the fact that it is a very challenging environment, what I always say to our Moneybox customers is tens of thousands of people are still getting onto the property ladder every year. So it goes back to what we were talking about earlier of trying to balance off, yes, acknowledging it's an extremely challenging environment, but trying to make sure people don't give up on these financial goals. The number of Moneybox lifetime ISA house purchases was up 62% in 2024 compared to the year before. And HMRC data said that there was 56,900 people bought a house with the help of a lifetime ISA in 23-24. So as I say, that is a lot of people still getting onto the property ladder. How do you balance off those topics in terms of, yes, it's a challenging environment versus it's still kind of achievable? And when people say to you, I'd like to get onto the property ladder, what are the types of things that you talk to them about at the moment?
Yeah, so it's definitely a long-term goal. And if you're using something like a lifetime ISA, you have to definitely know that you want to buy a house and be committed to it. And with the price of houses versus average earnings, because that obviously impacts the amount that you can get in terms of a mortgage. That's 4.5 times or 5 times earnings. It just means that you'll have to save for that bit longer, or with another person, so with a partner or friend or family member. But it's like we said at the start of the episode, I think if you have a few small but big goals and you have a date in the future that you'd like to reach them by, then you can achieve big goals. A lot of the stuff that we hear, I think it's important to note this, with regards to the economy or with regards to the country, are actually averages. So we're speaking about the country as a whole. This doesn't have to reflect your personal situation. There are still tens of thousands of people, as you said, doing things like buying houses, and yeah, it can be the same for the people listening.
So the most popular question that we got through from our customers was, what's the best account to use when saving up for a house deposit? Now, both of us have referenced the lifetime ISA, so I should give some context of what that is. The lifetime ISA is an account you can use. You can save up to £4,000 a year into it, and the government will top that up by 25%. So that's a maximum £1,000 a year you can get. And you can use that for two purposes. You can use it either for buying your first home, or you can also use it to supplement your retirement savings. So that's £1,000 government bonus potentially every tax year. And you can also buddy up with a partner, for example, who might also be able to use a lifetime ISA and put both of those together to get onto the property ladder. So it's quite a generous incentive for the government to get people onto the property ladder. And it's been around from about 2017. There's a couple of caveats that people always need to be aware of. One is the property price cap, which is £450,000, which in most parts of the country is still quite generous, and you can buy a hell of a lot of house for £450,000. There is certain areas, kind of predominantly London and London boroughs, where £450,000 can be quite restrictive. And Moneybox and others have been campaigning for the government to increase that property price cap, because property prices have increased significantly since the lifetime ISA was introduced in 2017. The other caveat is, if you use your lifetime ISA for any purpose other than getting onto the property ladder, or in the future supplementing your retirement savings, there is a 25% penalty, and you actually end up losing some of your own money in an emergency where you need to get access to your lifetime ISA savings. So that's the context around it. When people talk to you about the lifetime ISA, obviously there's the London-centric kind of house price cap. But is there any other issues that you talk to people about, or do you generally just kind of talk about the benefits of the 25% free from the government?
Yeah, huge fan of the lifetime ISA. Very glad to have helped people get on the property ladder by using one. I think the only build that I have on what you said is that you need to be between 18 and 39 to open one. And you need to have it open for a year before you can actually use your savings. So a good trick is just to open one with £1, and you have until the end of the tax year you're currently in to then put in the other 3,999, and then that clock will then reset again on the 6th of April. But huge fan of the account, and I'm sure it's helping lots of people realize their home ownership dreams. Because when it comes to buying a house, I don't think it's just about the property. Houses where you'll hopefully spend a lot of your life, make memories, start a family. It's actually very important for the country that people have a place that they can call home and that they can build upon.
And we've seen as well, via kind of Moneybox customers, but also just general research, that getting onto the property ladder can unlock lots of other kind of financial goals. People quite quickly then shift to investing, saving for retirement, kind of protecting their family, life insurance, all that sort of stuff. Getting onto the property ladder can be a real stepping stone. So everything that we can do to help people do that will be a bonus, as I say, for the country. And I know, as we mentioned at the very start, you've been in Westminster and Downing Street, as have I, and we will keep knocking on those doors and asking the government to take a look at that house price cap, because it is just something that, given what's happened to house prices since the lifetime ISA was introduced, it is something that they need to look at, and hopefully 2025 will be that year.
Yep.
I mentioned that question about when is the right time to buy, and I think you've talked about a lot of the personal considerations. When I think about it, there will always be external factors at play that will make you question, okay, is this the right time for me to actually make that decision and get on the property ladder? We're having this conversation in January. We've got changes to stamp duty that are coming up at the end of March. Obviously, there are predictions about what interest rates might do. But for my money, getting on the property ladder is a very, very personal decision. And it is very much about what is right for your personal situation, what is right for your family. and this is a home that you're hopefully going to live in for many, many years. So those kind of internal factors, as I would call them, are more important than those external factors about trying to time things kind of perfectly when you think about the economy or anything like that. Anything that you would add to that when someone says, look, should I be looking at purchasing in 2025?
Yeah, I mean, if we look at the last 20 years, there'll always have been a reason why you shouldn't buy, whether that's the cost of living crisis, the pandemic, awaiting the decision from Brexit, recovering from the 2008 financial crisis. There'll always be some sort of market shock that we're anticipating or recovering from. But as long as you can buy something that you can afford, a place that you want to live in, and that's within your budget, and you're working with a mortgage broker that you trust, a lawyer, and so on, then it'll come down to your specific situation.
And speaking of working with brokers and those external advisors, how early do you think is reasonable for people that might be looking to buy in 2025 to start speaking to a broker, start getting their documents together? How early before you think you might actually be wanting to purchase a home would you be advising kind of starting those conversations?
Yeah, a mortgage broker you can speak to very early. You can speak to like a year in advance of buying the house, and they'll be able to help you with things like budgets and credit scores and stuff. And you may even be able to get your decision in principle through your mortgage broker as well. So that's a great thing to get started early. And that relationship that you have with the mortgage broker is the thing which, for me, makes everything else so much easier.
And then because it's January, let's talk about kind of habits and resolutions. So for somebody that wants to get onto the property ladder, maybe not in 2025, but a few years kind of after that, what are some healthy habits that they can get into this year that will make it easier for them to get onto the property ladder in a few years' time?
Yeah, well, when you buy a house, the lender will be looking at the last 6 months of your bank statement typically. So it's just about making sure that your spending, your debt, all the things to do with the money that's coming in and out of your bank account is tidied up and is in a way that you'd be happy for the lender to see.
Okay. Last but certainly not least, retirement and pensions. Again, I always find from speaking with customers, this is always on people's to-do list. They always want to sort out their pensions, make sure that they're contributing enough, make sure that they know where all of their old pensions are. But sometimes they're a little bit further down the to-do list. So if people are looking to get onto the property ladder or build up an emergency fund, those things tend to be prioritized, and retirement and pensions can be something that they potentially think about later. It is also a difficult environment. Again, if we talk about things like cost of living crisis, there are a lot of pressure on people's finances. There's a lot of pressure on people's paychecks. So it can be quite difficult to think about and prioritize your pension savings, which you're probably not going to be able to use or want to use for 20 or 30 years. So it's quite difficult to get that balance right. Again, from the research that we have recently done, when we speak to people that have gotten onto the property ladder, they do quite quickly refocus on things like investing and retirement. And actually, those things, when we speak to people, they treat those equally once they've gotten onto the property ladder. How do you talk to the Mr. Moneyjar community and on your socials about things like pensions and retirement? Because it can be a difficult balance to get right between pressures on your finances today versus saving for that future you in 20 or 30 years' time.
Yeah, pensions are a funny one because they seem like a really far away thing, but it's the money that you're saving into your pension now, which is going to grow into money that you'll either use to be able to work a bit less or retire completely. The thing that I say to people that tends to catch their attention is that we have 14 or 15 trillion pounds worth of household wealth in the UK, and just under half of that is pension wealth. It's a huge financial store of wealth for the country. We're working longer than ever before. We're living longer than ever before, and these are great things. But the average person will probably spend something like a third of their life in retirement potentially. And so planning for that as early as you can is going to be important. And it all starts from the money that you're putting into your pension now.
Yeah, I think sometimes when we talk about pensions, I think it can feel sometimes that people think it's a choice between, say, for example, spending £100 today, and that might be spending on things that you need. I'm not talking about just pure discretionary spending, spending on things that you need, or putting £100 into a savings account that you will access when you're 60, 60, 65, whatever it might be, whenever you choose to retire. But I always say to people, it's not quite that, it's not as equal as that, because there are plenty of other people basically that pay into your pension. The government pay into your pension in the form of tax relief. If you're in traditional salaried employment, your employer will also be paying into your pension. So it's not all up to you to get what can sometimes be quite a scary number. If people try and work out how much they should have in their pension pot, it's going to end up being quite a lot, because, as you say, we are living longer, and therefore will probably, hopefully, be retired for longer. So we're probably going to need to save up quite a bit over our working life. But I do say you are not doing this on your own. As I say, the government do it as well with you via tax relief, and your employer might do it as well.
Yeah. So when it comes to saving into your pension, if people are not sure about the end goal, there's three variables that you can look at. There is the age you'd like to retire by. There is the pension pot size you'd like to reach. And then there's the amount that you're putting in every month, whether that's an absolute financial amount or a percentage of your earnings. And what I would say to everyone is get a pension calculator and put in the amount that you're putting in every month from your salary. Put in the age that you'd like to retire by, and it will give you a pension pot size. And most pension calculators will also let you know whether you are on track to hit your retirement goal or whether there's a shortfall. And then you can either do a slider on the retirement age or on the monthly contribution to get that pension pot size to your target amount. The pension pot size needs to be able to deliver you an income that's roughly 2/3 of your average working life income. This is because as people get older, certain assumptions are made. The fact that they'll have paid off their mortgages, that any kids that they have will have grown up and flown the nest, as it were. But the first step that you can do, super simple, get a pension calculator and have a play with those three variables.
We talked earlier about something called auto enrollment, and that is a very important kind of policy change that came in about a decade ago. And it means that instead of having to opt into a pension, which was the previous case, people are automatically enrolled into a pension. So a lot of people listening to this and a lot of people out there may have been or will have been automatically enrolled into pensions for most jobs that you pick up now. And actually, that's created a different problem, potentially a better problem,
Yeah.
in terms of lost pension pots. So there are millions of lost pension pots out there with billions of pounds in them.
Several billion.
Billions of pounds in them that we need as an industry to reunite people with. And there is something coming eventually called Pensions Dashboard, where people will be able to log into a pensions dashboard and they will be able to see the pension savings that they have made or they have been automatically enrolled into over the course of the last decade. But I think a good financial resolution, people don't need to wait for the pensions dashboard. This is something that they can go and do themselves. There are plenty of places that you can go now and track down your old pensions. There is a government tracing service. Moneybox have a pensions tracing service as well. So a good financial resolution, I think, for people, if they want to do something positive when it comes to their pensions, is basically just getting your CV, getting your LinkedIn, whatever it might be, and just checking if you had a pension pot associated with each of those jobs, and just making sure as a bare minimum, you know where those pension pots are, and make sure that you're not part of one of those millions of pension pots with billions of pounds in it, because it just wouldn't happen with a savings account or a bank account. We wouldn't walk away from accounts like that with our money in it, but it does by the way that the pensions industry has kind of worked out over the last decade. As I say, we have these lost pots problem.
Yeah, and that's a fantastic point, actually, because we saw workplace pension adoption rates skyrocket after auto enrollment to the point where now 88% of employees participate in a workplace pension. And yeah, I'm pretty sure that if it was down to you to make those savings manually, we wouldn't see percentages as high as that. So
Yeah, and maybe in the coming years, there's been talk about kind of bolting on other savings options on top of auto enrollment. So there's groups that have done studies about putting money into savings accounts automatically from your paycheck, like you
Yeah,
do with your pension.
I love that. I would love to see that come in.
And it's until we get there, kind of with that policy or technology, it's something we can easily kind of replicate ourselves
For
with our
ourselves.
own savings accounts and direct debits
Standing
and that sort of
order,
stuff
yeah.
as well. Question number one that we got from our customers, there was quite a lot of different variations of this question, but it is probably one of the most misunderstood pieces of pensions, and that's about tax relief going into your pension pot. Again, it's probably a topic that's difficult to discuss and articulate verbally, so maybe we both kind of have a crack at it, but I'll
Yeah.
pass that one to you first. So if
Yeah.
you're trying to explain pensions tax relief to a friend down the pub, how would you go about that?
What I would say is that when you receive your payslip, your monthly salary, that amount of money has already been taxed. So if you earn 50K or less, you're a basic rate taxpayer. So if you earn £8 in your take home pay, you're actually paid £10 gross, and then it was taxed at 20%. If you put that £8 into a pension, the government will add that £2 back in. That's what we call tax relief. That happens automatically. Now, if you are a higher or additional rate taxpayer, that means that you earn up to 125K or more, you can do a self-assessment tax return every year, and you can claim back the 40% or 45% rates that you'd have been taxed on your money as well. And with all of this tax relief going into your pension month after month, this is something that's going to help you to get to that final pension pot size a lot quicker.
I think that's an incredibly good explanation, which I am not sure I can improve on. Sometimes, sometimes I think about it the other way, and I think if you have a choice, say about £100 of your pay, you can either choose to get that into your bank account, into your pocket that you can spend, and then it will be reduced by tax. So it'll either be reduced by 20%, 40%, or 45%, depending on how much tax you pay. So you'll either get 80 quid into your bank account, you get 60 quid into your bank account, or you'll get 55 quid if you're an additional rate taxpayer. You can choose to put that whole £100 into your pension, and it's not reduced by tax at all. That's what happens automatically via your paycheck. But sometimes I think it works too well, and people don't realize that tax relief or tax discount that they're getting, and they can get that whole £100 before tax into their pension. It can then go, it can be invested. Vast majority of people don't know actually that their pension funds are invested, and it can grow for the next 20, 30, 40 years tax-free in the wrapper. Yes, you may pay some tax when you kind of draw down on your pension in retirement, but it's an incredibly good deal between, as I say, paying the tax and getting the money into your bank account to spend, which obviously we need to do with a lot of our salary, but some of it we can move into our pension tax-free and it can grow for the next 20, 30, 40 years. Okay, I think we've done a reasonably good job verbally articulating tax relief. So when we talk about pensions, and I think sometimes when we talk about saving, investing, and home buying as well, I think we get sometimes caught into the trap of assuming that everybody is in traditional salaried employment, but obviously we know there's a huge amount of people who are self-employed out there. How should people who are self-employed think about their pension? They obviously don't necessarily have a month-by-month paycheck that's exactly the same. So it can be quite difficult to budget for pension savings. Do you have any advice to people who are self-employed about how they can think about their pension savings?
Yeah. So when we look at workplace pension participation rates, the percentage is 88%, and that's due in large part due to auto enrollment. When we look at the pension adoption rates for the self-employed, there are various estimates, but it falls to about a third. So what I like to say to self-employed people and business owners is you're making money in your business, and you might be making a lot of money, but you need to realize some of that wealth by either paying into a pension or saving that money or investing that money. And paying into a pension allows you to grow your wealth as you grow your business. I completely get, particularly in those early days of starting a business when you're not sure when the next paycheck will come from, or you're just busy. There's just so many things you have to set up by yourself when you run a business. But if you can set up a SIP, a self-invested personal pension, and start to put money away into that, that means that, you know, your business could make less money in a particular year or particular quarter, but you've got that wealth set aside. And there are tax advantages to doing this as well. So you can pay up to £60,000 per tax year into a pension, and you can actually offset this against your company profits, thus reducing your corporation tax. So the government actually wants to encourage this type of saving from business owners as well.
Well, amazingly, we are coming towards the end of our time. It's absolutely flown by. And personally speaking, I am very optimistic for the year ahead, especially after this conversation. Now, if I pick up social media, or if I pick up a newspaper, or if I turn on the news, sometimes it can be quite easy to be pessimistic. It tends to be the more negative things get the headlines. And especially, I feel sometimes in January, February, these things can weigh heavily on us, and it can be more easy sometimes to be pessimistic at this time of year. But can we come up together with 3 reasons to be optimistic for 2025 going ahead? I'll let you have the first stab.
Yeah, 2025 for me is quite a symbolic year. It is a quarter century. It is halfway through the decade, and it's also 5 years on from the pandemic, which thankfully seems to be behind us completely. So I've been treating 2025 almost like a reset of the decade. I've gone, okay, the first half of the 20s has gone the way it's gone, but now's actually an opportunity to begin again, to leave behind the things that weren't serving me and weren't working well for me, and to take forward the good habits, the good relationships, all the stuff that was working. So that's how I'm choosing to see this year. That's one reason to be optimistic. Secondly, I did make reference to this earlier on in the episode. When you read the news, when you hear stuff about the economy, they're talking about the economy as a whole. Actually, a lot of things in finances are like this. So house prices is always an average. Salaries is an average. Any of the percentages that you hear will tend to be averages. And averages disguise spreads. They disguise the individual stories that are happening in between this large, in between this overall number. So things may be going a certain way on average, but that doesn't mean they have to be going that way for you. There are people listening to this who are going to buy houses this year. They're going to get pay rises this year. They're going to start investing this year. So focus on your own personal situation and focus on what you can control. I think the final thing that I'll say is, if you are in a position where you can save, invest, pay off your debt, think about retirement, think about buying a house, you have your health, your family, friends, you're actually doing far better than you think. So we may as well start the year as we plan to go on, and maybe do a bit less doom scrolling.
I think those are absolutely brilliant reasons. I'll add in a couple that, because you can never have too many reasons to be optimistic. On your third one, if you're in a position to save, invest, buy a home, or plan for your retirement, as you mentioned, you're in probably a better position than you think. And there are also lots of, I would say, kind of helping hands to help you get there. So there are lots of incentives, some of the things that we talked about. So tax relief is there to help you save for your pension. The lifetime ISA is there to help you save, get onto the property ladder. Other ISAs, cash and stocks and shares ISAs, are there to help you build up your emergency fund or help you to build wealth for your future. There are lots of things there to kind of help you towards your financial goals. So that's one reason to be optimistic for me. And the other one that I'll just add in is, again, some of the headlines can be quite negative, but a lot of, I would say, for want of like non-jargon words, some of the economic indicators out there aren't actually that bad. The economy is just about growing. Unemployment, thankfully, is pretty low from historic reasons. Wages are, generally speaking, growing. Inflation is a lot lower than it was a couple of years ago. So I think there's plenty of reasons out there to be optimistic, and I'm ready to run through the wall into 2025.
Yeah, 2025 is going to be a good year. The 2020s have been tough, but we've come through a once in a century global pandemic, and we're still here. So I think we're doing great.
I think that plus the cost of living crisis has just shown how resilient
we all
people are. So yeah, time to head into 2025 now and accelerate towards those financial goals. Well, thank you very much for that, Rotimi. There is nobody I would rather have spent this time with early on in January, setting our goals, our intentions, and articulating how good a year we think 2025 is going to be. So thank you very much for spending this time with us.
Likewise, Brian. Thanks for having me.